with Asoba DeFi, and there's a recent paper that has been circulating within the Bitcoin Twitter space about a certain Harvard PhD candidate who is essentially proposed the idea that central banks should start including Bitcoin as part of their overall asset reserve strategy. And the tweets that were kind of talking about it, they did a lot of editorialization of what the content was actually talking about. I think we have a tweet here, just in Harvard paper tells central banks buy Bitcoin. The implication there gradually then it all happens quickly. The implication there is that this is more validation about the legitimacy and sort of the future permanence of Bitcoin as sort of an aspect of the financial world. While I don't disagree with the core premise there, I think it's always valuable to dig a little bit deeper when you see a source provide an interpretation of a paper, to actually go into the paper itself, look at the study methodology, get a really clear sense of how they're actually conducting the study. So with that in mind, I was able to actually get a copy of the paper. This is a paper called Hedging Sanctions Risk, Cryptocurrency in Central Bank Reserves, and this is by a PhD candidate by the name of Matthew Ferranti. So immediately off the bat, the headlines of Harvard tells central banks to do X, that's a bit of an exaggeration of what's actually being proposed or promoted. In fact, what's actually being suggested here is that Bitcoin is a valuable tool within this sort of tool set of hedging sanctions. So with that in mind, I think it's helpful to just kind of dive into the paper a little bit. This is something that's personally curious for me, so I'm going to do a little bit of reaction to the paper. I'll skip around a little bit and just kind of focus on the juicy bits, so to speak. But I'm really interested in seeing both the methodology as well as the conclusions that came from the study methodology and the approach to modeling taken. So without further ado, jumping into the abstract. Starting at the top, central banks may shift their international reserve holdings in order to protect themselves ex ante, or sort of before the case, against the risk of financial sanctions by fiat reserve currency issuers. So this is primarily for preparation for sanctions from either the US or the United States or both. So those are the only bodies that are really engaging in the sanctions game right now. So from 2016 to 2021, countries facing a higher risk of US sanctions increased the gold share of their reserves more than countries facing a lower risk of US sanctions. Okay, that's interesting. So this paper explores potential for Bitcoin to serve as an alternative hedging asset. I describe a dynamic Bayesian copula model. So this is an econometric approach that looks at various random variables, so more than one random variable. In this case, it's Bitcoin as one variable, gold as another, maybe some other reserve assets as other variables. And it looks to identify or build a model that explains the dependencies that exist between these different variables. Now, keep in mind also that the variables in question are essentially time series data sets. So there's a time series associated, or sort of a set of compounded returns over time for Bitcoin versus gold versus these other asset classes. And we'll see in the paper what other asset classes are in there. So it describes the dynamic Bayesian copula model to simulate the joint returns of Bitcoin and other reserve assets under a wide range of plausible sanctions probabilities. Assuming mean variance preferences, a modest risk of sanctions significantly increases optimal gold and Bitcoin allocations. So that's an interesting conclusion that they're kind of highlighting at the very front in this abstract, which I think logically makes sense, but I'd be really curious to see how they develop a model that sort of that appropriately and reasonably explains the relationships that we're seeing. If a central bank cannot acquire sufficient gold to hedge its sanctions risk, the optimal Bitcoin share rises further, suggesting that gold and Bitcoin are imperfect substitutes. I conclude that sanction risk may diminish the appeal of U.S. treasuries, propel broader diversification in central bank reserves, and bolster the long-run fundamental value of both cryptocurrency and gold. So I think this topic is really interesting because I think we have a really good use case in Russia of a country that is essentially a living example of what are you doing ex ante. Because if you recall, prior to the Ukrainian investigation, prior to the Ukrainian invasion, there were numerous articles discussing Russia's increase in gold and other foreign currencies, and their sort of historical, over the last 10 years, divestment from U.S. treasuries and U.S. dollars as part of their reserves. So it's all in preparation of a geopolitical showdown that I'm seeing now. Putin must have seen it as inevitable, whether it was direct warfare or the BRICS moving more aggressively to break out of the World Trade Organization and create their own, banking system, et cetera, that is in direct competition with the West. There would be some form of either economic or hot warfare between the West and sort of this set of BRICS doing this. So that may have played into the decision making by Russia to have this long game about how they manage their reserves. But I think the other interesting piece is that if we look at the share of Bitcoin mining, Russia makes up a meaningful portion of the total hash power across the entire Bitcoin network. Now, this article says 11%. The research paper says a slightly different percent. Whether Russia is top 3 or top 5, they're at a minimum within the top 5 countries that have the most direct contribution to hash power within the Bitcoin network. And when you consider that most of the miners in Russia have some form of direct affiliation with the state, whereas in the United States, that is much less so. The operators are much more independent. You also then begin to see that the level of direct involvement that the Russian government itself has within the Bitcoin network. That begins to present a really interesting picture of their strategy and how the author of this paper must have kind of looked at Russia as at least one example as an inspiration for the hypothesis that they're testing within this modeling exercise. So back to the paper. The introduction. So they just walk through introducing cryptocurrencies, what they are, market size, some institutional or central bank level of adoption. So El Salvador, for example, and Central African Republic are two examples of sovereign states that are adopting Bitcoin or recognizing Bitcoin as legal tender. There are discussions about whether Bitcoin is actually an appropriate medium of exchange, but whether it is or not, that's sort of out of the scope of this conversation. We see that it is meaningful. It's starting to get some meaningful adoption. There's an explicit reference to Russia in terms of the concerted attacks via sanctions. Having assets frozen, etc. Freezing about $300 billion worth of Russian assets, or half of their international reserves. So you can see the benefit to Russia, not only of being a commodities king, but then also having these strategic reserves that they have that they've migrated onto in anticipation of this kind of concerted attack. Doesn't mean that they'll be successful, but it certainly. I think the focus of this is really just on what are the likely strategies that ex ante a government or a central bank is likely to take to bolster its reserves. So digging down here, overview of financial sanctions. It looks at the sort of history of the use of financial sanctions in the modern context, which started after World War I, League of Nations. A lot of mention of the U.S. because essentially the U.S. and the EU are really the only two countries that exhibit meaningful sanctions across the board. So sanctions and central bank gold allocations, and this is where this author does a little interesting dig into first the allocation or the percent of gold reserves as a percent of total reserves. And you can see that there was a dip prior to the Great Recession and then a bounce back up. So likely there are heightened requirements around reserve requirements, and that resulted in gold becoming much more seen as much more valuable than it was prior to 2008, when reserve requirements were lower, just requirements in general of diligence were lower in terms of deals because everything was supposed to work. And then 2008 kind of made an adjustment to that. And you can see also that gold shares among countries or central banks that own gold, it's heavily concentrated, about 25% or less. There's a long tail of countries that have higher shares of gold as their central bank reserves. I'd be interested to see who those countries are. But in any case, Then this paper goes into identifying what is a variable as a proxy for financial sanctions risk, which is military import deals. They have a very interesting justification for this, because what they're showing is that in order to determine sanctions risk, they look at or at least behaviors with regards to gold. They look at countries that have a high sanctions risk as determined by doing weapons deals with Russia and China versus the United States. They see the relationship between gold share of their reserves, and that there seems to be somewhat of a correlation between allyship with China and Russia and higher levels of reserves in gold versus countries that are more militarily aligned with the United States. So again, it's an interesting rationale for what's clearly some inductive reasoning behind sort of thinking about that relationship. It's creative, and that's what you need in this kind of space. We'll see. It feels tenuous. We'll see how it impacts the rest of the study. This dives into characteristics of cryptocurrency. It gets into Bitcoin, Ethereum. It gets into the comparison between proof of work and proof of stake, and I think that's where, again, the author is making the case here that Bitcoin is much more suitable for central banks that are looking for protection against sanctions, because proof of work, the ability to censor, requires ownership of more than 50% of total hash rate across the system. But as we can see, the actual, let's see if we can find, the actual share of Bitcoin mining by country, even though the United States has a massive share, the United States government does not control much of any of it at all. Whereas you compare it to more authoritarian or high power distance countries like Russia, the government has more direct access and more direct control over these. But the point here is that because of the censorship protections that the Bitcoin network provides, it provides assurance that you don't have specific miners getting censored, or even having whole nodes being captured or taken or censored by agents that are working against a particular government. That's a tremendous appeal behind Bitcoin, and that's that level of security, along with being a real asset, because essentially Bitcoin is a market for the electricity that's used to mine the Bitcoin. So you can see, between the security, the anti-censorship, it being a commodity or a real asset, it is an attractive look at in terms of a risk asset to include in your reserves. And certainly we've seen great institutional adoption of Bitcoin in spite of the crypto winter that is coming on right now. So we get into the actual model creation piece, the reserve assets model. They explore a few different model types, time series models. So within time series, they have univariate equations and multivariate equations. So they're determining which to focus on. They look at their uninformative priors. So they look at what are some variables they can kind of assess for volatility and to determine correlation between the different variables that we're looking at. So again, Bitcoin, gold, and other reserve assets. Then they also set some informative priors for the mean returns, and what they're focusing on here is that there is so the effective supply can only shrink, so it's deflationary. Looks like about 20% of Bitcoin had not been touched over 5 years, and 1% is lost. So again, you're sort of looking at sort of the Bitcoins that are not available for actual circulation or sort of disrupting velocity. And that has an impact on the actual price. So again, daily exchange volume explains up to 85% of the variation in Bitcoin price, suggesting the long-term return of Bitcoin may be tied to the gross rate of wealth creation. So again, that's so what we're basically saying is that as the rate of growth slows, the long-run returns are also going to slow down. And so this is what influenced the study author here to, as they look back at historical Bitcoin prices to kind of project into the future, since this is a time series analysis that they're doing, they had to attenuate the returns, because from 2012 to 2022, Bitcoin grew 100%, over 100% per year, the compound annualized growth rate. Clearly, that's not realistic for the long term, so he needed to find some way of modifying that so at least it feels more realistic into the future. And again, this is not meant to be like the crystal ball, but this is more just meant to be a rough idea of what the returns are in order to evaluate it comparatively to gold or other reserve assets. So then they get the data, so it's historical data, they do the computation based on the models that we talked about. Then they do the model validation to ensure repeatability with other data sets, or other portions of the same data set. Okay, so now we get into portfolio choice optimization, which is sort of the meat and potatoes of what we talked about here. And so in the scenarios, they have their base case, which is a 1 in 100 sanction probability, high risk 1 in 10, low risk 1 in 1,000, high correlation 1 in 100, low correlation 1 in 100, and then we have basically the high correlation is basically US and EU both putting sanctions on the same actor. All right, so then they look at the without sanctions portfolio allocation, so optimal shares without sanctions. We see that Bitcoin is somewhere around 2 to 3%. Gold is pretty low, and 2-year treasuries make up the vast majority. Two-year U.S. treasuries make up the vast majority, and stocks make up the other portion of that. With sanction, though, that changes significantly, and gold becomes, more than 50% gold becomes sort of the optimal stacking. The Bitcoin amount rises to about the same level as world stock. U.S. treasuries is significantly lower. U.S. two-year euro bond, surprisingly, is quite a bit higher. Then they look at only varying Bitcoin, or basically saying we can only acquire more Bitcoin. We have everything else is the same. What is the allocation if we can only acquire more Bitcoin? And what that looks like is, based on the different risk case. If there's the high risk case, then your allocation to Bitcoin is going to be over 40%. Base case is 10%, so that's, I think, 1 in 100. And then the 1/10 the risk, so 1 in 1,000 risk, your allocation becomes down to 2 to 3%. So again, pretty low. Again, so it all really just depends on the scenario that determines the optimal shares, and it's pretty dramatic if it's high risk of sanctions. Then we get into, okay, if we vary gold and Bitcoin, what does the distribution look like? In the 10x risk case, we see the optimal gold shares being close to 100%. So if you're able to vary gold and Bitcoin, it's still wildly preferable in your high risk of sanctions case to really stockpile gold very heavily, and essentially no other assets or minimal other assets, because other assets, there is some level of control, and presumably, certainly treasuries, 2-year treasuries and 2-year euro bonds for sure out of the question. So then we look at optimal Bitcoin shares. So your share as a percent, depending on your risk level. You can see basically the sensitivity curve, I guess, for each level of Bitcoin shares. And so again, with the high risk cases, you're seeing preference towards higher allocations of Bitcoin. So I think overall, it presents a really interesting case for certainly the accumulation of Bitcoin and how countries deal with the publicity around that. Whether they're public and open about it, with El Salvador, and whether that creates additional either public pressure or financial pressure on them, or potential concerted hacks or attacks on their nodes or on their mining efforts. That's sort of a decision that's going to be individual to each country. I probably would hold it close to the chest if I was a central bank for those exact same reasons, particularly if I'm an African country. But I think the other piece that's useful for African countries is that very clearly the gold allocation for most of Africa, maybe the Zimbabwe's or South Africa's might be a slight difference there, but for most of Africa, that's likely going to be unrealistic. And so that's where, this idea of focusing efforts on mining Bitcoin and accumulating Bitcoin, so you're able to vary Bitcoin only, so it shows, really aggressively building your allocation up to 40%. Now, there's some things that probably need to be explored more. One is the actual the real risk of sanctions. We probably want to have a more historical look than just sort of the last 5 years in terms of military purchases. But I think that would provide a lot of context about like how do we actually test the model that we've built right here. But it certainly is a good start in terms of getting us thinking about how do we, from an African country perspective, surely, like how do we actually build the level of reserves that are necessary to overcome the sovereign debt risk or the sovereign credit risk that so many African countries deal with regards to being able to get more lending at reasonable market rates for actual development of more resources. So certainly engaging in mining, stockpiling, Bitcoin specifically might actually be a really interesting route for African governments to take in this perspective. Of course, we need to get them to overcome sort of the negative impressions of cryptocurrency as it is, but I think green is a universal language, so to speak. Everybody likes money. To be able to provide more protection against what are oftentimes very abusive sanctions or geopolitical tactics by the U.S. or EU, I think that's a valuable peace of mind for a lot of countries to have, or at least attempt to have. But yeah, I'm curious to hear your thoughts or your takes on this particular article about Harvard telling central banks to buy Bitcoin. Leave the comments below and like and subscribe, and we'll see you in the next video.